So if you have been involved in buying and selling real estate for any length of time, you know that there is nothing cut and dry, nothing black and white, nothing that is very few transactions, especially as an investor. I guess I'm speaking more to investors. There is usually nothing that is very cut and dry. Those things are few and far between. Most of the time, when you are an investor, you're coming into a distressed situation. You're coming into a person that is distressed, a situation that is distressed, or a actual property that is distressed. Basically what I'm saying is there's usually a problem that needs to be solved in order to facilitate a transaction. It's never as cut and dry as the person saying this is the price, the buyer saying, okay, I will pay that price. Everything is clear. I give the money, I get the title, bam, we have a transaction. It's usually never that clear, cut and dry. One situation that as an investor you will come across is trying to buy a property, a seller reaching out to you or coming across a seller lead as to where a property has an existing mortgage. So it's going to be the case in that's going to be the situation in a lot of cases. A creative solution that a lot of investors are able to present to sellers, and a lot of sellers will accept. It's called a wraparound mortgage. Basically, it's what they'll do is they create an instrument, another mortgage. So what they do is that the person who is selling in this situation, they have a certain amount of equity in that property, and they don't want to lose that property, but it's not prudent for the investor to be able to give them all that equity up front. They would pay them out in installments because for closing costs, for everything that involves fixing up the property, getting it marketable, getting it to where the investor is making a profit, giving that person their equity just doesn't make sense. But that person needs to exit this transaction, needs to exit this building, exit this property, but still want to capture their equity. So what as an investor you're able to do to think creatively and to create a win-win solution, because we never want to we don't want as an investor to take advantage of a person's situation unless they want to unless they are very aware of what they're losing out on, the opportunity cost, and they are aware. We always make people aware of what their options are, and that way when they come to a decision, they understand what their trade-offs are, what their advantages are, what their disadvantages are, and they understand where we are coming from as investors. So with this wraparound mortgage, it's basically you're creating another instrument, another note, a mortgage for that equity. Basically what we'll do is we'll take your existing equity, we'll keep that in place. We'll take your existing mortgage and we'll wrap that around the dollar amount of equity that you have and create a new instrument, an agreement for deed. Of course, this is done legally with title companies, an agreement for deed. Nowadays, with more and more title companies becoming more and more savvy and investor friendly, all you have to do is get the right document, sign the right contract, hand that over to a title company, and they know exactly what to do as far as creating that instrument and making sure that it is a actual recorded deed, no different than any other financial instrument of a mortgage agreement for deed. In this agreement, and you'll explain this to the seller, and this will be all in the paperwork, basically you agree to make that monthly mortgage payment for the next, however the remaining amount for that existing mortgage, or sometimes they will or sometimes I have seen some investors will put in for a definite time, maybe 5 to 10 years, and that will give them time to exit the strategy properly, whether that be through refinancing, selling, owner financing, being able to rehab, refinance, whatever their exit strategy is, whatever the duration is for that. In some cases, if the whatever the duration of the mortgage is, that will be the duration of the agreement. In some cases, whatever the duration of their exit strategy or whatever they agree with the seller, whatever their exit strategy being. The exit strategy could be owner financing, selling owner financing to somebody else and collecting a lump sum and then collecting a little bit above what they're paying the seller. An exit strategy could be holding onto that property, rehabbing, holding for appreciation, and then be able to refinance or be able to sell on terms or be able to sell outright for a higher amount for appreciation. Whatever the case may be, that in that agreement, the duration of the terms of when the seller will be getting their payment, that's included in this instrument. Now, everything is always negotiable, but to sweeten the deal, a lot of times investors will add interest onto their equitable interest. So, for example, if a seller is holding on or trying to capture $20,000 in equity that they have, a potential buyer can incentivize and sweeten that deal by offering 5% interest on that $20,000, and it sweetens the deal for the seller. Basically, again, for a wraparound mortgage, an investor will offer to take over the payments for the seller and pay them their equity spread out over a certain amount of time in order to capture their equity, in order to realize their exit strategy plan. I am a licensed realtor and fiduciary. A lot of realtors don't like to deal with creative solutions, but these are the types of things that I'm able to help sellers and buyers present for creative solutions. And no matter what, you're creating a win-win situation for buyers and for sellers, because again, like I mentioned before, nothing is always black and white, cut and dry, especially when you're dealing with distress situations. You're dealing with sellers that need to expedite the purchase process, and when you have investors who are looking for good deals in order to produce great returns.